Most investors organize the stock market using outdated sectors that simply don't make sense anymore. The traditional label survived, but the financial reality changed. Today, we're ditching the arbitrary categories to deliver a structural macroeconomic analysis using a much more powerful framework, the complete map of financial currents. While the herd is distracted by flashy headlines, reactive, offensive versus defensive terms on the surface, the real money is made by understanding the deep water flows carrying global capital forward. Hello, my name is Daniel Young, and this is Adaptive Perspective. Every week, we separate currents from noise and opportunity from fear using an income focused strategy in closed end funds. It's not polished, certainly not scripted, definitely not herd thinking. We don't chase headlines, we navigate markets. Now, let me be clear, I'm not a financial advisor or a fiduciary. I'm an income hunter, a strategist who filters the noise, follows the data, and targets durable cash flow, even when that means taking a different course. In this Sunday briefing, we're breaking down the six major financial currents and four underlying rip currents shifting the economy right now, cutting through the Wall Street terminology and showing you how to position your income strategy for long term growth. Let's look at the map. For months, I've talked about financial currents, waves, ripples, and tides. This week, I want to pull back the curtain and show you the complete map. Most investors organize the market using sectors. Morningstar has a fantastic list of 11 categories. The problem is that the problem is that modern markets no longer fit neatly into those boxes. The label survived, but the reality changed. Technology, energy, and AI touch almost every sector. And what do defensive and offensive stocks even mean? Analysts throw out those terms, yet never define them. In case you didn't already know, defensive stocks are supposed to defend your portfolio in economic downturns, and offensive stocks are supposed to grow your portfolio as the market rises. The problem is that approach makes you reactive. By the time a stock becomes offensive or defensive, the deeper movement has already occurred. You're responding to yesterday's current instead of positioning for tomorrow's. So instead of this antiquated strategy, I propose one major change. Organize the market around financial currents. And a financial current is simply a large flow of capital moving through the economy. And every investment ultimately sits inside of one of six major currents. Current one, bonds and bonds proxies. This includes traditional bonds, municipal bonds, CLOs, loans, debt securities, BDCs, utilities, and other income producing financial vehicles. Bonds are the financial plumbing of the economy. Most investors ignore them because they aren't flashy, but that doesn't make them unimportant. Current two, real estate. Real estate is technically a bond proxy, but it's large enough to deserve its own current. Property values, construction activity, financing conditions, and development all flow through this channel. Current three, end to end energy, oil, natural gas, utilities, refining, transportation of the processed energy in pipelines, as well as how that energy is transported in 18 wheelers, ships, and railroads. Every product and service in the economy depends on energy somewhere in the chain. And without energy, nothing else expands. Current number four, the technology family tree. Hardware, software, semiconductors, networks, applications, artificial intelligence. This is the current that receives the most attention because it's the most visible. But technology depends on financing, infrastructure, and energy. And as such, it often appears downstream from the other currents. Current five, blue chips. Blue chips are large, mature businesses that often benefit from multiple currents simultaneously because they operate across numerous industries and economic environments. They aren't a separate sector. they're a convergence point where several currents meet. In a steady or lower rate environment, these currents will increase in volume. However, that's not necessarily the best time to buy them. The ideal conditions for moving into blue chips are when interest rates increase or when extreme market fear results in steep fund discounts. Current 6, stocks at large. This is the broad catch-all market current. Everything that doesn't fit clearly elsewhere eventually ends up here, making it the widest and least precise current on the map. Stocks at large generally fall into two categories: single current businesses and what I call portfolios in a can. Single current businesses are often tied to a specific industry, niche market, or economic condition. They may perform exceptionally well when their current is flowing, but they are also more vulnerable when the current slows or changes direction. Portfolios in a can take the opposite approach. Instead of concentrating on a single current, they own pieces of many currents simultaneously. Broad market ETFs, index funds, sometimes closed-end funds, fall into this category. While diversification can reduce risk, it also means you're owning strong currents, weak currents, and stagnant currents at the same time. Neither approach is inherently wrong. The challenge is that both tend to be reactive rather than directional. They reflect where capital has already moved instead of targeting the current still carrying the market forward. And that's why I prefer identifying the strongest active financial currents first and then selecting funds positioned inside those currents. Rather than owning a little bit of everything, I want the portfolio aligned with the areas where capital is actively flowing. Now, beneath the 6 currents are smaller reactionary currents that constantly redirect capital. These are RIP currents. The first would be higher US inflation. When inflation rises and rates move higher, capital often shifts toward forward markets, sovereign debt, and defensive financing vehicles. RIP current 2, lower US inflation. When inflation falls and rates decline, capital tends to move toward financing vehicles, real estate, infrastructure, expansion projects, and growth-oriented investments. RIP current 3, private credit. Private credit reacts differently than public credit. Public credit is highly regulated and super transparent. Private credit is not publicly known. It's not generally nefarious, but it does have more risk, and a growing economy needs both. RIP current 4, the banking responses. US banks react to inflation differently than bonds, loans, and private lenders. Bond prices are inversely tied to interest rates, whereas bank rates rise along interest rates to increase bank profits. While US banks react to Federal Reserve policy, foreign banking systems react to their own economic realities. Those differences create additional capital flows beneath the surface. And now, beneath every current and RIP current lies the undertow, a collection of smaller forces quietly pulling capital from one area to another. Most investors never notice the undertow itself. They only notice the outcome after the capital has already moved. And that's why I spend less time studying headlines and more time studying capital flows. Headlines tell us where the market has been. Currents help reveal Currents help reveal where capital or where the economy or where the market is moving next. The goal isn't finding the perfect fund. It's understanding the water well enough to know how you're positioned and when you need to move. And once you know that, fund selection becomes much easier. So with that in mind, currents, RIP currents, undertow. With that in mind, let's move into this week's closed-end fund snapshot and look at the funds positioned inside the strongest active currents, which are bonds and bonds proxies, real estate, end-to-end energy, and the technology family tree. So let me share my screen and you'll see the pre-list or the initial list. Not every fund's going to stay, but I left it this way for a reason, just so you can see how we sift. So that it's 17 funds currently. There we go, all the way down. Um, we own the ones in blue. I've been working on some things. I've been working on getting every ticker or every fund its own specific contact card, which is honestly hard to display on the screen. But every fund gets its own specific contact card and also a smaller description of where it fits into that or where it fits into the economy. All of these funds are triple asterisks outside of IGR, which remains just a good dollar cost average pickup. It's premium by a little bit, but it's pretty much break even. But that is a great dollar cost average price and a fantastic steady dividend, which is why it's still on the list. But not every fund is going to stay on this list. This is what I currently have in cash in my account, and I'm going to get to this number in a little bit. So here's how I would sort the list. When the list comes in, it's sorted by discount and then by target, and then I order it by dividend policy. But without going through the list one by one, here are the funds that I would initially cull from the list. Uh, I, this is me. I like monthly payers. I will deal with a quarterly payer when I need to, but I prefer a monthly payer. So for ASG, which is blue chips, and USA, which is blue chips, and GCV, which is still blue chips, it's convertibles, which is decent right now, but it's still blue chips. These funds don't fit the metric. That leaves JRS, which is it fits the metric. It's both REIT and preferreds. That fits. That's bond proxy and bonds proxy. But I just prefer a monthly payer. Go back. I'll show you the contact card for it. That way you can decide, you can pause it and read and see if it's what you like. On my end of things, yeah, I mean, on my end of things, I already own RFI, still already own IGR. So also, I already own three PIMCO funds. And I get that it has the top yield. I get that I mean, I'm not afraid of aggressive funds from um, oh, thanks, malware. Um, from funds that perform, to be honest. Aggressive doesn't scare me, but I already own three PIMCO funds. I don't need another one. So that leaves me with this list. Is there anything else I would take off? Yes. NBXG is all stocks. Maggie is energy, but on my end of things, that price has gone up, which is great. And even though the discount still makes it a great deal, my goal is to optimize. So I want to buy either in dollar cost average territory, meaning, well, if it's level or under, that's where I like to buy because I can decrease my overall share price. That's not always the case. Sometimes you buy when stocks are a little higher, sometimes when they're a little lower, and then you get that dollar cost average price. I get that. My goal is not to buy up here when it's insanely popular. I'd rather buy something cheaper. So not Meggy. HGLB is still rocky. I think it's more their 5% investment into Fermi. I've read two aspects of Fermi. Fermi is still looking for its tenant. They've had a shakeup in the higher up rankings, but the overall market opinion is that it's still a decent idea, or still I think it's a great idea. It's still a decent place to park your money per se. On but honestly, at 5% of the portfolio, it's not going to crazy dent their value. It finally looks like their NAV has risen a little bit. That's nice. Um, I wouldn't be afraid of investing there. So it would make my tentative list, I guess you could say. It's not an outright delete. Um, I'm more on the fence. BRW has, gosh, it really is just a great it's like a all-terrain income vehicle. Remains my largest portfolio holding. I'm trying not to add to that, not for fears of, we'll say like almost like anti-diversification, not for that. It's more of I don't want to overweight my portfolio there and miss an opportunity somewhere else. So that leaves me with this. So as it goes for currents, so bonds and bonds proxies, real estate, energy, and then technology last. Now we can go by sectors. So we have REIT, that hits a lot of different sectors. Uh, so we end up with real estate, end-to-end energy. Uh, yes, it's got part of that tech family tree to it, but not outright bonds. Then we have U.S. and international, U.S. and international. Well, international, U.S. and international. That's pretty much PIMCO's play. Um, let's see, U.S. focused. That's a REIT plus a special dividend payer, and then PDT. PDT is on the list for two reasons. Well, three reasons. One, it's that bond proxy portfolio, preferred plus a like a sleeper energy portfolio. Two, in a lower rate environment, two things happen. They have a history of paying special dividends. They also have a history of a higher rate or a higher dividend. So their last higher dividend in a lower rate environment was this amount. If we trade that, it changes their dividend, right, from a little below 8 to a little above 9. And I don't the goal is yes to buy 9% plus dividends, but I also like buying dividends that raise or lift or increase. So even though it's below an 8 now, I would be okay buying it, knowing that this forever stagnant or potentially rising inflation fear that's bleeding into the market right now isn't reality. The market still points and the economy still points to lower interest rates in our future. That and Kevin Warsh wants to cut rates. So I don't believe that mindset is here to stay. Or I don't believe that mindset is going to somehow infect the reality that we're going to have higher for longer rates. So with lower rates coming, and with this company, this fund, uh, changing dividend and paying special dividends. There we go, in lower rate environment. I would consider it in a pickup. So we can look at how to spend $1,600 based on fund. It's not so much picking the right fund. You could have your own way of doing this, but if uh, the simplest, I mean, we could go by type of current, um, bonds, real estate, end-to-end energy, technology in that order, or we could go by total dividend per period or annual dividend. We could maximize investment per, or we could maximize the investment per fund based on that 1600. And I like whole shares. That's me. Uh, those are all the same. And we can go 150 maybe. Yeah. I still like sets of 100. That's just me. Nope, that's fine. That could be fine based on the market and that. Okay, so if we go by just on maximizing how many shares, we end up with this, which would be a dollar cost average move for me, basically buying that fund on par. That's about on par. Dollar cost average, dollar cost average, dollar cost average. DOY I think would be basically on par. That's a little under. PDT I don't own. Would I buy it? For 100 shares, I could buy it. I mean, my max goal on total funds is 25. Buying PDT would put me at 24. I like it, and I get it that, I mean, you can look at this journey in lots of different ways. Total funds, different sectors, how many shares, how much money you have invested, overall dividend percentage, dividend per period, total dividend, average yield, lots of different ways. Uh, what I would really like to do on my end of things, and what would really help my decision process, is I want a fund that has year over year steady net asset value or NAV, or really a rising net asset value over the last year. So I would go back into CF Connect and look at every fund and then filter the list further based on that metric and then pick a top fund from there. I could mix and match. I mean, I could get IGR, I could get I don't I don't think I can get, let's see, it's going to throw off the entire list. Um, let's see, 1600 starts at about there. So I can pick up IGR and PTY, right? That's close to just the $18 alone from IGR. But you can mix and match however you want. But at the end of the day, the goal is not to pick the best fund, it's to pick the best place for your money in the greater scheme of things. But it's all based on your metrics. So on my end, I would go through and look at the overall net asset value and let that help guide my choice. But for now, these are the funds that make the list this week. And I like options. I mean, I really do. I like options, but honestly, you could put all these things in the same barrel, right? All of them exist in the currents that are flowing right now. It's really hard to pick just one. But if you really pigeonholed me, or if you really cornered me to pick just one, I might actually pick PDT simply because it's got that energy component in preferred shares, and I don't have that sector allocation inside my portfolio. But IGR is really tempting because it's pretty much selling on par. Now, I would buy it in the individual brokerage because I already have it. I wouldn't buy it in the Roth because it doesn't meet the metric. If I'm going to pick up something new, it's got to have triple asterisk. Um, but since I already have it, it is a great dollar cost average move. So I hate to not answer the what am I buying tomorrow because I simply still don't know. I really just have to deep dive more data. But if you really nailed me to a wall or backed me into a corner, I can tell you the funds that really appeal to me: DSL, PTY, RFI, PDT, IGR. Like it's really the whole list. And in times like this, when it's like I have all these different options, I need a different metric or another metric. And looking at net asset value over the last year has been a good measure for me. So that's the list right now. But yeah, I would look at the net asset value and then call the list from there. And I could show it on video, but just makes the video longer. Um, maybe that's a video for a different time. So that's my list right now based on the currents that are flowing right now. So I'll leave you with this. Most people react to what they hear. Successful people learn to identify the underlying structures, adapt in real time, and position themselves accordingly. My goal isn't to tell you what to think or even what to buy. It's to teach you how to read the water for yourself. Most investors spend their time chasing reflections and reacting to yesterday's market. But the reflections aren't the story, the currents are. So to learn to learn to identify financial currents, position yourself inside them, allow the market to carry you forward instead of constantly fighting the water. And when the currents begin to shift, as they always do, you'll recognize the change early, reposition accordingly, and continue moving forward while others are still trying to figure out what happened. So that's all I got for this week. I'll see you next Sunday. I wish you a great week. And whatever you have planned for the week, I wish you success. I'm an achiever kind of person. I like a to-do list. If you're kind of scrambling through the week, not really knowing what to do, make yourself a list, keep it, cross the stuff off, see your accomplishments at the end of the week, and then keep making your list. And on my end, I've already made some notes for next week's video. I've got notes of what I have to do tomorrow, and I've got some stuff to do. So I wish you a successful week. And on my end, I'll work on. Uh, I will. I'll work on looking at net asset values. And if you want that as part of a video, just let me know. So have a great week. I wish you success, and I will see y'all next weekend. Bye bye.